Let's dive right into it. Well, thank you all for being here. Thank you, Startup Grind, for hosting this awesome conference. My name's Hamza, and I'm an insights manager at Carta. And I'm really excited to share with you all some of the key trends we're seeing for AI companies when it comes to fundraising and growing and scaling up. The key question we're going to look at here that AI kind of poses at us, and I hope some of the data I share will kind of illuminate where things are headed, is how much capital and labor do you really need to scale a startup? So capital in the form of investments from angel groups or accelerators and VCs, and labor in the form of your team, your employees. And AI is kind of fundamentally transforming both of these aspects of scaling a startup. So we'll kind of share a lot of data on that. This is a thrilling kickoff from our lawyers to get us started, that this information's for informational purposes only and not financial advice. But to give you a little bit of sense of where this data comes from, Carta serves over 45,000 private companies based in the US in terms of helping them with managing their equity. And as a result of that, we have over 1 million employees represented on our platform. We also do fund administration for over 2,500 venture capital funds in the US. So what my team does on the insights team is to anonymously analyze that data and then share findings with the public to help make the startup ecosystem more transparent. And so I'm excited to share some of our latest findings up through the first half of 2025 with you all today from that rich data set. And I'm going to break it down into 3 parts. First, I'm going to give a little bit of market context on where things stand in the general venture ecosystem in the US, then dive into fundraising trends specifically for AI companies and how they compare to non-AI companies. And then finally get into some of the aspects around AI company building, like co-founders and early employees. And I'm happy to take questions in the chat. Mostly we'll address them at the end, but feel free to pop anything more urgent in there as it comes up. So this is our kind of 30,000 foot view of the venture capital ecosystem, where we're graphing the total amount of cash raised by startups on Carta each quarter. And you can really see the 2021 boom here, where things really shot up, as it's highlighted in orange, followed by a really sharp downturn in 2022. And since then, we've kind of come up a little bit from the minimum, which was in early 2023, but we haven't seen a market boom again since then. There is kind of this AI boom everyone's talking about, and since ChatGPT's launch in late 2022, we've seen so many AI startups emerge. And while they are taking in a lot of the capital, as you'll see in some of the later slides, that doesn't mean that the total amount of venture capital being invested into startups has risen again to 2021 levels. Having said, we do expect 2025 to be slightly above 2024 levels in terms of the total cash raised. And we're seeing kind of fewer rounds happening overall, but with more capital available in those individual rounds, especially for the most sought after companies, which are often in the AI industry. But the overall kind of fundraising environment hasn't been that great, especially for non-AI companies. And we can really see that when we look at graduation rates. So this graph is showing the percent of companies that raised a seed round that then went on to raise a Series A round for different time intervals since that seed round. I know it's a lot of numbers here, but if we focus in just on the 2-year graduation rate, so how many seed stage companies then raised a Series A round within 2 years, back in the 2018, 2019 cohort, we saw graduation rates of 30+%. And since the downturn and the change in the market environments, that's really fallen down to closer to 15%. So it's nearly halved in just the span of 4 or 5 years. We also see that when we look at the median time from one round to the next, whether it's from seed to Series A to B, or B to C, The traditional wisdom used to be that you raise around every 18 to 24 months, and that's that window that we've highlighted in orange there. But we've really seen these timelines get extended out where the medians are now in the 2.5 to even 3 year range. But very recently, let's say in the first half of this year, we have seen these time intervals come down a little bit. You can see that each of these lines has kind of come down slightly from their most recent maximum in the past 1 to 2 quarters. And so we think that might be an indicator that the fundraising environment is easing up a little and capital is becoming a little more available as founders need it. Another indicator along those lines is the rate of down round. So a down round being when the current valuation is lower than the last round's valuation, not a position many founders would like to be in. And historically on Carta, the rate of down rounds was pretty low, close to around 10% in 2019. But after the downturn, when a lot of companies had inflated valuations and had to face a correction, we saw the rate of down rounds really spike up to around 20% and even higher some quarters. But again, as with the time between rounds, we're finally starting to see this come down a little bit. As of Q2, the rate of down rounds was just 17% on startups on Carta. So we think this is another indicator that perhaps the fundraising environment is getting a little better. Obviously, the downturn did have lasting impacts for a lot of startups, but we might finally be past the worst of it. But now I want to talk about how in the current fundraising environment, how have AI companies been doing specifically? Well, they're taking in a growing larger and larger share of all of venture capital. This graph's showing, broken out by fundraising stage, the percent of all venture capital going specifically to AI companies, comparing the first half of 2024 to the first half of this year in orange. And as you can see, for most fundraising stages, it's really gone up. So last year we saw 36% of cash going to AI companies. This year, it's around 51% at seed stage. And especially at the very late stages of the startup life cycle, Series D, Series E+, AI companies are now taking in a majority of all cash. Geographically, the Bay Area continues to be very dominant. Across all industries, we find that the Bay Area takes in around 42% of all venture capital in the country. In AI specifically, it's actually higher. It's at 51%. So a majority of the AI cash to be raised is going to companies in the Bay Area. And after that, we see New York at 11%, Boston around 6%, Seattle around 5%, Denver around 5%. And I found it interesting here that Seattle and Denver, both as metro areas, are a bit higher in the ranking for AI specifically than for all industries. So that suggests perhaps a little bit of specialization taking place. And then when it comes to valuations, we've definitely seen an AI premium. This graph's plotting seed stage valuations and round sizes. So the round sizes are on the x-axis and the valuations are on the y-axis. And it's broken out by industry. The size of each bubble represents the number in the sample of companies. And this kind of gives you a sense of which industries are more capital efficient or capital intensive, et cetera. For example, in the bottom right quadrant, you see biotech, where they have above average round sizes, but below average valuations, which is in line with expectations, especially at the seed stage. On the other hand, in the opposite corner, top left, you have ad tech, lower than average round sizes, but higher than average valuations. And then, of course, the big orange bubble there is AI software companies, which have the biggest rounds and the highest valuations. Looking specifically at AI software versus non-AI software. So AI software companies are represented here in orange, and all others in black. You can see there's a premium at the seed stage for both valuations and round sizes. It's around 15% of a premium at the seed stage. And we actually see this at other stages too. At Series A, the gap even widens further. There's around a 30% AI premium when it comes to pre-money valuations. The median for AI companies is 55 million. So yeah, AI companies are getting pricey, but for other non-AI software companies, it's only 42 million. This trend continues at Series B as well. You can see the gap being even higher here, 150 versus 100 million. And the premium for valuations is actually higher than the premium for round sizes. And what that means, if you do the math, is that AI companies typically have lower dilution per round. So in this graph here, we're kind of plotting the distribution of dilution for the middle 50% of companies. So the bottom of the line is the 25th percentile, the top of the line is the 75th percentile. And in almost every case here, you can see that the AI line is shorter and below the non-AI line. So startups are kind of fundamentally changing the dilution game now too when it comes to the AI sector. It has the potential to fundamentally change the entire founder ownership trajectory that we see too. In this graph, we've kind of plotted the median journey of a company. It's not broken out by AI versus non-AI yet, but we will do that soon. But this graph showing the typical journey where at the seed stage, founders typically have around 56% of the company in terms of fully diluted shares after the seed round. And by Series A, they typically lose the majority, holding around 36%. All the way at Series D, we're seeing the founding team have usually around 11% of ownership left. But as companies scale up faster, have less dilution, they might fundamentally change how the venture game is played. And another point of evidence in that regard is revenue. So ARR, this data is from Silicon Valley Bank, not from us, but it shows how ARR has changed at the Series A stage from 2021 to 2024. Not only at the median, but the whole distribution, including the 25th percentile, the 75th percentile of ARR at Series A has doubled. So if companies can generate revenue and become profitable much faster, they may not need to go through all those fundraising stages. They may still do it for other reasons, maybe to get certain names on the cap table, to build certain relationships. But the typical startup journey that we're used to may actually change in the next few years. And now I want to get into a little bit of the company building aspect of it, including founders and employees and jobs. So the first trend that we've seen is kind of the rise of solo founders. Solo founded startups have become a lot more common. In 2015, only around 17% of startups were founded by just a single founder, whereas last year we saw that jump up to 35%. And of course, things like vibe coding and AI productivity tools have a lot to do with that. Historically, we found that there was a bit of an underrepresentation of solo founded companies amongst all the cash that they were able to raise. So maybe VCs were less willing to give money to solo founders, but we're seeing that trend reverse as well. That was part of a separate analysis that we did and are working on a solo founders project that'll have more on that. But we're seeing kind of solo founders both become more common and start taking in a higher percentage of venture capital. Not only are there fewer co-founders, we're also seeing it take longer for startups to build out their teams. So this graph's showing the median time and the average time it takes from founding to hire the first, second, and third employee, very crucial roles in any startup. But we're seeing here that founders are working on their companies for longer on their own. For example, for the first employee, the median time went from 214 days to 284 days as of last year. And what that means is that at each fundraising stage, founders are having a lower headcount. So at seed, for example, in 2020, the median company or average company had around 8 employees, and now they have 6. And we're seeing that slowly carry out into later stages as well. What that means, unfortunately, is that the startup economy in terms of its job market hasn't grown much, and it's much harder to find a job in that sense. This graph showing the movement of employees on a monthly basis over time. And the black line specifically shows the number of new hires each month across all startups on Carta. And the dotted lines shows the total number of departures, including both voluntary and involuntary layoffs. So when you look at the area between the black line and the dotted line, that tells you, how much net headcount growth there is, or how many new jobs are being created across the entire startup economy. And if you look at 2023 onwards, what you'll really see is that those two lines are almost touching. They're basically on top of each other, signifying very little to no net headcount growth. On the compensation side, however, things are a little more complicated. We've seen, over the past couple of years that there were much lower equity packages being issued to employees, but on the other hand, salaries were a bit of a mixed bag. We have seen salaries moderately increase around most roles, but where we've seen the largest increase is for AI and machine learning engineers. And I think that's another, expected trend that we've been able to show with the data. So what this graph is showing is the percentage change in salary for AI and machine learning engineers from January of last year to June of this year. So about a 1.5 year period. And it's broken out by valuation tier, meaning the valuation of the company doing the hiring at the time of hiring. And what it shows is that for really small companies, especially those valued under 25 million, we're seeing a 9% increase in both the median salary and the 90th percentile salary for those AI engineers. And, engineers at bigger companies have also seen significant salary increases, higher than other roles. But, at a unicorn, for example, all the way on the right, that $1 billion to $10 billion category, the effect is a bit lower because I guess, the effect of any single engineer on a much later stage company isn't going to be as pivotal or crucial as it will be in the very early stages. And that's where we're seeing the talent war, the heavy competition for talent amongst companies building in the AI sector. So these are kind of the main trends we're seeing. And when it comes to compensation, we expect the talent war to continue for a while. And if you'd like to continue to be kind of where the data leads, you can sign up for our weekly newsletter, the Data Minute, to receive, one chart a week right in your inbox about the venture ecosystem. And also, if you'd like to have a copy of this deck, I'll drop my email in the chat and I'll be happy to share it with you. But happy to take any questions now. That's all I had prepared. Let me take a look at the Q&A now. Okay, I see a question here. Is the location showed international? Unfortunately not. We were only able to compare metro areas within the United States. So that's specifically based on census definitions from the US government on metropolitan statistical areas. We have published global metrics on other things. For example, there was a startup equity and workforce report for the APAC and Middle East region, answering Delma's question there. That looked at equity compensation trends and hiring trends in the Asia region. Andy asks, are there time intervals between stages extended because the founder's need for funding has decreased, or are there a number of circumstances that cause the extension? That's a great question. I think, it's a multifaceted phenomenon. There's a lot going on here. The need for funding is changing because companies are able to stay lean longer, but also, the hype or the attention right now is around AI companies, whereas companies in other sectors especially are struggling and finding it more difficult to fundraise even when they do have that need. Yeah, a couple of people are asking questions specifically about how AI interacts with specific verticals, maybe healthcare, et cetera. That's some analysis that we're going to do in the near future. We recently updated our data taxonomy to be able to kind of cross-cut between whether a company is AI or not and which vertical or industry it's operating in. So please, stay tuned for more data on that end. Alin asks if we can make the data available. Unfortunately, we're not able to share our raw data because it is customer data, very sensitive. So we only share it in aggregated and anonymized formats. Yogesh is asking how much money is being raised across each round. I'm assuming you mean the total cash being raised at each round rather than like the median, because the median I did share earlier here. So for example, like the median round size for an AI software company this year has been 3.6 million. For Series A, it's been around 12 million. And for Series B, it's been around 27 million. So those are like the individual round sizes. But if you're talking about the total across all companies at that stage, we do have that data. It's just not in this kind of presentation, but happy to share that after. We do have pre-seed data. So we have an entire pre-seed report that we publish every quarter. It's not in this presentation, but I can drop the link in the chat below to the pre-seed report. And in future iterations of that report, we will be breaking out AI as well. There's a good question here about the definition of AI. So it's a bit difficult, to verify or manually categorize companies on our own. We essentially use a process that primarily relies on the company's own definition for categorizing it as AI or not. And I realize, there are limitations to that, but I also think there are going to be limitations to whichever methodology that you choose. Because, for example, if we manually tagged AI companies, someone could still ask, why is your definition the right one? Is there a time when raise velocity picks up? So if we look at the overall quarterly data, I wouldn't say there's like a clear trend of when most of the cash is being raised by startups. I will say in most years, there's a little bit of a stronger Q4 than Q3, probably because of an end of year rush. But there has been a lot of variability, honestly. Has where people are getting their seed and round money changed over time, be it geographically or otherwise? That's a great question. I think, we've definitely seen the emergence of more and more early stage ecosystems in terms of, pre-seed seed investors distributed around the country. So I would definitely say that earlier stages tend to be more geographically distributed than later stages, where the vast majority of rounds for later stage are happening in the Bay Area. The average cycle times from seed to A to B and so on. Raghavendra, could you please clarify what you mean by cycle time there? Yeah, like I showed here, the median time from seed to A. So yeah, that's what's here in this graph. A little bit over 2 years for seed to A, and then closer to 3 years for A to B. That's what we're seeing in the data for the median startup. Kazim is asking about travel companies. I'm not sure if we have enough data on that industry specifically. I've never looked at it, but I'm happy to do so, afterwards, so we can get in touch. All right, and I guess the last question I'll take a look at here is, with the recent news around circular deal flow between AI, NVIDIA, and Oracle, do you think we're at the end stage of an AI bubble? Amazing question. I mean, it's so hard to predict the future, honestly, and just given what I've seen in the news and the data, etc., I don't think that'll prevent the hype from living on. So I think at least for a good chunk of time, we're going to still see a lot of enthusiasm and hype around AI. All right. Well, thank you all for being here. Really appreciate it. Just gonna drop my email here. If you would like a copy of the slides, feel free to shoot me an email. And thank you all for attending. Hope you enjoy the rest of the conference.